Value investing is an investment strategy that focuses on buying stocks with a low price but high potential for long-term growth. It involves researching and analyzing companies to identify undervalued stocks and then making investments in those stocks. Hi, my name is Lulu, and this video provides a comprehensive overview of value investing, from the basics of how it works to more advanced strategies for identifying companies and making smart investments. It also includes tips on how to invest money for the long run to maximize returns while minimizing risks. What is value investing? Value investing is a strategy of investing in stocks with the aim of finding companies that have a lower price compared to its intrinsic value. As an investor, the goal is to buy undervalued companies and hold them until their value rises, thus earning a profit. By using this approach, investors can potentially earn higher returns from their investments than they would by investing in stocks without taking into account their intrinsic value. Value investing requires extensive research and analysis in order to identify companies that are undervalued and thus provide the potential for higher returns. There are many forms of value investing, such as Graham value investing, Benjamin Graham's approach to value investing. Value investors can be passive or active. Passive involves buying a market index and waiting for the market to change, and active involves actively looking for underpriced securities in the market. Graham value investing is a specific form of value investing. It involves buying stocks that are trading below their intrinsic value and is based on the work of Benjamin Graham, the father of modern finance. Graham was one of the first to teach investors about the benefits and risks associated with investing in stocks. He taught that not all securities are created equal when it comes to potential returns, and that investors should focus on companies with strong fundamentals as opposed to those with high prices. To be considered a good investment, a company must have a strong financial position, operating history, management quality, and future prospects, among other factors specified by Graham's value investing approach. Graham's conceptual framework of efficient market hypothesis led to the development of value investing. Graham introduced the concept of specific criteria for identifying undervalued stocks in his book, The Intelligent Investor. Graham's ideas have been influential and have contributed to a revision in the theory and practice of finance known as the efficient market hypothesis, EMH. How it works. Value investing is a type of investment strategy that focuses on purchasing stocks or other securities at a price below their intrinsic or book value. It is an approach to investing based on the idea that investors can identify undervalued stocks and profit from them in the long run. By researching a company's financial statements, investors can determine whether the stock is undervalued and then purchase it with the expectation of it increasing in the future. This method of investing requires careful analysis to identify potential investments and patience, as stocks may not reach their intrinsic value in 1 or 2 quarters, but rather over several years. Short-termism is the belief that investors focus most of their efforts on short-term profits and disregard long-term ramifications. This includes strategies such as investing for 1 quarter rather than 5 years. Short-termism has been characterized as a winner-takes-all mentality in which resources are allocated to make high returns in the short term without concern for the long-term impact. The behavioral finance theory suggests that individuals tend to be biased toward information that confirms their existing opinion, whereas they are less likely to seek out or hew to evidence that challenges it. This bias is known as confirmation bias. Researching a company's financial statements allows investors to determine whether the stock is undervalued and then purchase it with the expectation of it increasing in the future. How to identify companies for value investing. Value investing is a popular approach to investing focused on buying stocks of companies with strong fundamentals at a price below their intrinsic value. Identifying the right companies for value investing requires careful analysis of the company's financials, current market conditions, and industry trends. By using this approach, investors can find hidden gems in the stock market and create long-term wealth by holding on to these investments for years. Strategies for value investing. There are 2 main strategies utilized when value investing: bottom-up and top-down. Bottom-up focuses primarily on fundamental analysis of individual companies, while top-down typically relies on market indices to identify potential opportunities. Investors can also use both approaches in parallel to determine whether they should buy a company using one strategy and sell it using the other. This is an idea commonly referred to as buy low, sell high. Both strategies require careful monitoring of the general market conditions. With that said, below we will discuss each strategy in detail, with examples of how they have been used. Bottom-up value investing focuses on the fundamental analysis of individual companies. This strategy works by looking at factors such as a company's financial health, business model, and long-term growth prospects. These investments are bought when the stock price is undervalued relative to the fundamentals or future potential of a company. Bottom-up investors can also use fundamental data to determine whether they should buy or sell a particular company from an investor's point of view. They will do this by comparing how specific stocks would be valued in differently optimistic and pessimistic scenarios that could affect their business. The process of analyzing the company's asset value is known as value investing. The following are some common bottom-up investment strategies. Growth investing involves buying stocks that have strong growth potential. These can take the form of companies in an industry that have yet to show their true potential, or they can be companies with a large number of attractive growth opportunities, such as young firms with innovative new products. Growth investors believe that this is where future profits will come from. Decline investing focuses on picking undervalued assets and selling them at the end of their decline cycle when they reach their highest point before they start to go down. The most famous example of an asset that fell in value over a short period before subsequently returning to its initial purchasing price is the stock of Microsoft in 1999. This was the year after Mr. Bill Gates announced he would step down as CEO and a year after it became clear that Windows XP would be released. Despite all this bad news, Microsoft stock skyrocketed from $21 to $68 per share between 1998 and 2000, until it collapsed to around $20 per share by the beginning of 2001, at which point investors started buying shares at cheaper prices. Risks of value investing. The risks of value investing. The risks of value investing can be further divided into two types: risk of outperformance and risk of underperformance. Outperforming is the goal of most value investors, but it can also lead to a vicious cycle in which the market declines and returns are reduced. Underperforming is not a good scenario either, as money becomes locked up in assets that are not performing well. The following subsections will explore these risks in detail. Outperformance risk. Vicious cycle of declining returns and losses. Value investing typically involves buying into companies that are selling for less than their intrinsic value. Generally, this is considered a long-term project, and the investor expects to hold the position for years or even decades. In order to have a chance of outperforming in value investing, someone should identify undervalued assets with the potential to appreciate over time. If these assets are not able to appreciate in value because they are out of favor, or if there is no one left willing to buy them at their current price, then they will become more expensive, and there will be less margin of safety left for future capital appreciation. This scenario leads to a situation where the value investor will be unable to outperform traditional market returns. Value investing is usually applied to publicly traded securities, but can also apply to other assets, including real estate. Thank you for watching.